Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, the mayor of the great state of real estate in Texas, Mr. Michael Becker. Michael, how are you?
Hey, Paul, how's it going? Doing well?
Yeah, going okay. It's getting on towards middle of spring season, beautiful flowers outside, and good time to buy or sell real estate in Texas. Don't forget the DFW multifamily field trip, the bus tour, as we call it, May 16th, the Old Capital bus tour, May 16th. This is a great one. Michael has participated as a speaker at that event. We put 50 people that come throughout the United States and want to learn something about real estate investing on the banker's perspective, not a syndicator, not a promoter. Nobody's running into the back of the room to spend $30,000 on an educational mentoring group. You know, you spend maybe $100 to come see us, plus your flight, whatever that's going to cost you to come see us. You want this because the math is the same in real estate, whether you're in San Francisco or in Jacksonville, Florida. You got to understand a little bit about what's going on and on multifamily investing, and if it's right for you. Don't make the large investment until you make the small investment. Come and see us in Dallas on May the 16th. Also to the Old Capital Conference, October 8th and 9th. In Frisco, Texas, again, a suburb of Dallas. We do it every year. It's our annual conference. There'll be 600 apartment investors throughout the United States coming to see us, and we talk a little bit about what's going on in multifamily. It's a good time to network and meet other folks in multifamily. This is a great opportunity. Come see us, Old Capital Conference. Again, you can go to the oldcapitalpodcast.com or oldcapitalconference.com and sign up, RSVP, and see us. One of the things I always forget about, Michael, is that we have a 2025 Multifamily Financing 101 white paper report and a due diligence checklist. That's for free. Michael, this is actually Michael's due diligence checklist. This is what he uses when he's trying to buy a property. He pushes it out there with an LOI, a letter of intent. When somebody is thinking about selling their property, Michael's thinking about buying it, and it's kind of a non-binding letter of intent. So it is the interest of what Michael wants to pay for the property, but also this due diligence checklist gives people an idea they're going to have to produce for Michael and his team to buy the property. So it's maybe a page and a half of great information about what you should be asking for when you want to acquire a property. So Michael, what's going on in your world these days?
I was thinking about the nosebleed I'm going to get by going north of 635 for your conference this year, way up in Frisco, Texas. So I appreciate sitting on the tollway to get there. But I guess that's the inside thing for those in the city, Paul.
Come on.
Excited about our podcast. Got a couple of our buddies on today, if you want to kick it off.
So let's talk a little bit about what we're going to talk about today. Ryan Heddleston has been a friend of ours for a long period of time. In fact, I don't even know how long Ryan has known. We've been friends with Ryan and Michael and I for how long, Brian?
So it's been about 15 years. I remember we met at a property in Uptown when, Michael, you were at Wells Fargo pushing loans, and Paul, you were, still doing what you're doing. And it's a lot has happened since now and then.
So we're going to talk about Ryan's journey in commercial real estate investing from where he started, which probably may sound similar to where maybe you're at and where he's at today, which is fantastic. And one of the things that we'll be talking about is what Ryan and one of his colleagues, a gentleman named Clayton Sievers, have gotten into. So we're going to talk to Clayton Sievers because we're coming around tax time here in Texas, not just your federal income taxes, but your state of Texas property taxes, your county taxes. And so now all the counties are coming out with what they think is the value of your real estate. You got to fight that every year because our properties get reassessed every year And I really don't understand how they come up with these values. A lot of people don't understand how they come up with these values, but we need somebody to help us to try to get these property values down. They're always trying to raise them up, and we're trying to get them down. So we'll be talking with Clayton Sievers and talk a little bit about fighting property taxes in Texas, because it's the largest line item on your operating statement of property taxes. Sometimes it's property insurance, but these days insurance keeps going up, but it's definitely property taxes. So I'm going to kick it over to Michael. Let's talk a little bit to Ryan Heddleston.
Hey, Ryan. Yeah, I know, like you mentioned, we've been friends a long time. Maybe just give everyone a little bit quick background on kind of how you got into the multifamily industry, and we'll kind of take it from there.
Absolutely. I have been doing investment real estate for over 20 years now. I kind of hate saying the number because it shows my age. But started in my early 20s. I've been very fortunate with the people that I've worked with and the markets that I've been in, primarily when I moved to Dallas, of course. But I'm from Pittsburgh, Pennsylvania originally, went to Texas Tech for college, moved back to Pittsburgh, started in a very entry-level sales job doing logistics, which I knew nothing about. And then unfortunately, my dad passed when I was 23. I got a small inheritance of $120,000, which at the time I thought was, $1 million. 120 is probably the value of one of your watches that you have, Becker.
I knew we're in a Fitbit. I don't have watches. Okay.
You're not putting on airs today. But yeah, all of this happened, had really no clear path. I had a very prestigious Texas Tech business degree, and was trying to figure out what I was going to do with my life and this small inheritance that I had. And I read Rich Dad, Poor Dad, and which, a lot of people know, and just the general ideas of it, and, owning real estate, being able to have the cash flow pay for your life and not have to work for a paycheck. All of that was very appealing to me. And so I took a guru class in Pittsburgh. I got my real estate license there, and I just started buying very rough properties in the inner city. 2 units to 6 units, a couple single family houses in there. I'd buy these things for like $10,000 a door. They were, buildings that were 100 years old, mostly Section 8, a lot of disrepair, knob and tube electrical wiring, bad plumbing. So I got to about 30 units combined, and I was doing everything myself, not really fixing the units because I'm not a very handy person, as Michael, you may know. But yeah, so I was, getting the buildings fixed up, dealing with the housing authority on Section 8, obviously dealing with the tenants, leasing, collecting money, and it was a grind. And one of the things that I really learned is you have to be, well capitalized to own these properties, and you don't just buy them and the cash flows in and you don't have to put money back into them. I remember when it rained, I would have a really hard time sleeping that night because I knew that most likely a couple of my buildings were going to have some serious leaks. So I learned a lot of tough lessons and, went through the school of hard knocks. And then I moved to Texas. I moved to Dallas in 2006 and started doing kind of the same thing. I was doing real estate brokerage and helping people buy, smaller properties. I was acquiring them myself in, blue collar markets, the Garlands, Mesquites, and Irvings of the world. And I got to a portfolio of about 50 units total, and I was just working my butt off, not making the best money compared to how hard I was working. And I realized I needed to get into the multifamily business. And I truly get to scale and, buying bigger buildings. So I partnered with a guy who had been in the business for a long time. His name was Michael Phillips. And in 2010, started doing buyer brokerage, helping people buy larger apartment complexes, and then doing partnerships, being the key principal on agency loans and buying deals that were 100, 200 plus units, all workforce housing, 1960s, 70s, and 80s. Started an in-house property management company, And then Becker, you and I bought a number of deals together back in those days when you graced the workforce housing world with your expertise. Yeah, in the good old days, and we did really well. We hit the market at a tremendous time post Great Financial Crisis, and interest rates were low and cap rates were high, and the timing was great, and I miss those days. But yeah, and so we continue to syndicate deals. Eventually, Mike Phillips and I started a fund. And, because moving from syndications to raising the fund was kind of the natural progression. And so in my total history, I've been able to acquire over 6,000 units, over 34 properties with over $500 million in total capitalization. And that includes moving to my new partnership with VaultCap Partners, which I founded in 2020 with my partner, Mark Christ, who's an absolute financial savant and a major driver of the growth and the success that we've had. Fortunately, he couldn't be on the podcast today. So yeah, things went well to begin in 2020, 2021, early 22. We were able to acquire 10 deals in that time. At the time, I was kind of frustrated because a lot of my peers in the workforce space were acquiring, 3, 4, 5,000 units plus. And luckily, we were disciplined enough to not buy a bunch of deals that we shouldn't have. In retrospect, it's served us well because we're in a very good position now to, we're not in the foxhole every day with a bunch of deals that are in trouble. And we can kind of touch on that later. But yeah, it's been a pretty interesting ride, and I'm really looking for this next cycle and the opportunities to come here. I think later this year and especially next year.
Yeah, that's a fun fact. The first 4 deals I did, Ryan was a partner in and managed at the time, and kind of from the beginnings. I can't wait for those days again because they really felt like the cap rates were high and rates were lower relative to that, and you had 20% upside on rents because there's a mom and pop operator, and then you probably had another 10 to 20% upside in other income because they weren't billing back for trash and pests or water and things like that. It really was a phenomenal time to get started with hindsight. So yeah, now I know you've kind of, like I said, done a little bit of everything, and now kind of getting a little bit more focused on it. What are some of the biggest takeaways that you've had here? I guess that obviously scaling is critical to have a quality of life, as well as making a little bit more money. It's a lot more efficient to do it on larger scale than kind of the onesie twosies. That's kind of, I started in a similar way with single family homes and sold all those after a couple of years and scaled up. Any other kind of lessons learned along the way that this kind of jump out if you're a new person trying to, you own 20 homes or 10 homes and you're trying to make that transition? What were some of the things that were successful as you made that transition from small scale to, 100-unit deal or 80-unit deal or whatever the first couple of deals you were that you did were?
The biggest thing is you don't know what you don't know when you're making that leap from the smaller 1 to 4 unit properties and amassing a portfolio of those compared to buying a 300 plus unit apartment complex. It's a very different operation. It takes a different mindset, and there's a lot of things you need to really understand going into it, because once you've bought the deal, if you haven't structured it properly or your underwriting is off, you don't know how to execute, you're going to be in trouble. Now, if you buy it well and at a good price, that can be much more forgiving. I think there's a lot of people who can be good operators, but if you buy a deal and you pay too much for it and you don't structure the capital stack properly, it doesn't matter how well you operate and execute, because you're swimming up the creek. I don't want to curse on Paul's podcast, on y'all's podcast. So I've got to watch myself here.
What team? So, for me, it was like assembling a team, and you say you don't know how to run a property if you never run a property. So you lean in on your property management company that should have the expertise to do that. Or, I had a financing background, but if you don't know how to put a commercial real estate loan together, how to structure it, or who even to go to get a loan, having a mortgage broker like Old Capital or Paul was certainly helpful. A lot of first timers that they kind of, he helps navigate the complex world that is that. And then, the last recent weeks, as you guys listen to this podcast, likely have been very volatile in the capital markets, to put it mildly. So, rates were going down, then they were going up, and then, just kind of all around. How do you, navigate that world without losing, a ton of sleep is, certainly something to do. And, the various other vendors that you have. So yeah, with all that said, kind of as you transition from kind of like your first deal to kind of getting 5,000-6,000 units, were there any raising money and kind of how you started out? Is there any kind of things you could think about when you're first kind of getting those first investors to give you money, and then kind of some of the mistakes you learned along the way and improve upon it? Is there any kind of thoughts or tips you could think about around getting someone to, actually give you money when you're starting out and have a either no or limited track record?
Yeah, no, the first thing, and you were mentioned it already, is just assembling a team, leveraging other people's experience who have been in the business for a while. Naturally, Paul, you're a great resource for that. You've been around for a long time and know a lot of people, and putting the inexperienced investors and having them partner in some structure, co-GPing, of course, being the most obvious one, is really the best way to cut your teeth in this business, in my opinion. Because, the guys like us who have been doing this for a long time, we've learned all those hard lessons and been through the battles, and those experiences are absolutely invaluable. So if you are a new investor and you're trying to break into buying larger apartment complexes, get with an experienced operator and add value to them, either by sourcing a deal or being able to, to bring equity to the table. But as far as, raising money, syndicating deals, or, we've done JV equity partnerships as well. It's really a matter of, that track record that you have and being able to show, hey, we've done this before and we know what we're doing. Being able to clearly lay out the plan that you have for the property that you're buying. Your underwriting needs to be absolutely rock solid, and you need to be able to go through every line item and explain why you believe the income should be what it is and the expenses those estimates should be what they are. But those are really the big parts of it, and being able to truly do your due diligence when you buy a property, especially these older 60s, 70s, 80s vintage deals. There's a lot of not only the deferred maintenance that you need to find and cure when you buy the property, but you really need to understand these properties will require a lot of money to keep them up over time. And so if you're planning on owning it for a few years and doing a full reposition, you don't have as much of that exposure, but you have to plan to hold these things for longer, especially if the market has done what it's done and there's been a correction, and you're holding this deal now for 3, 4, 5 years. So being properly capitalized, having the appropriate reserves in place for all of those items that come up, plumbing, electrical, there's a whole laundry list of things. HVAC, of course. You really need to understand what that is, and you can't get caught without having operating cash to take care of it.
Let's talk about some specific examples. Like you can't drive any place if your car has no gas, and that you can't buy an apartment building or buy real estate without having cash, liquidity. Have your money, your investors' money in your pocket raised before you go out there and do it. So again, how did you do that when you broke away from doing the duplexes, the fourplexes? How did you go out there and raise money, Ryan? Because that's what I'm thinking. I see the biggest issue right now for brand new, say, syndicators or just individual investors coming into the market is they just don't have enough money.
Sure. For me, it was getting with an experienced operator. And if I tried to go from just, having this 50-unit portfolio of single family houses and small 2 to 4 unit deals, I wouldn't have been able to scale nearly as quickly as I did. Being with someone who's been doing it for a long time, having that background, being able to go to our investors and say, hey, we've done a multitude of deals, and they're very similar to this, which are workforce housing repositions, where we take an older property that's been mismanaged, that has deferred maintenance, and we come in with a full plan to improve inject capital into the deal, cure all the deferred maintenance, make the property look great, make it a favorable place for people to live, and then do all the operational improvements, optimizing rents, cleaning up expenses, all of those things. It's having that, being able to partner with someone who has done that is just I know I'm being a little repetitive here, but that's just a huge part of it.
I definitely agree. And partnering up probably with Becker at the beginning was a kickoff for your business of multifamily. So if you have somebody that has deep knowledge, that has a track record, pony up to the bar, buy that person a drink, and try to become their best friend, and have them include you on their next deal. And then you can kind of figure out, working through the success that they have had in the past, that you can enjoy with partnering up with them on a new project. Michael, does Dallas County or Tarrant County, do they pick you up in a limousine once a year and put the champagne on ice in the back when they drive you to have you pay all those property taxes that you guys have been paying every year?
They do not. No, they don't treat us very well, Paul.
Yeah, it's quite the opposite, right?
Every April.
So it's kind of April Fool's Day with Tarrant County or Dallas County or Denton County or Collin County. Again, all these
Travis
counties,
County is the worst, to be honest with you.
Travis, which is down in Austin. So they take you to the woodshed once a year and give you a laugh when you open up the envelope, or you go onto their website and you see what now they valued your property at, where your income is down, your operating expenses are up, and you're like, what are they saying? What is this property worth? It's almost like that meme that what the appraiser sees the house as and what you see the house as. And it's absolutely amazing that people can live in Texas and put up with property valuations. So Michael, talk a little bit about your experience with property taxes again.
Yeah, it's a year in, year out grind. It's a racket, just seems like in Texas, we get reassessed every single year. It's not like a lot of places across the country where they have reassessments that, your assessment set every several years, or there's caps on the annual increases. In Texas, if you own a commercial building, it's not your homestead, they can just reassess you up to market. So, some years you've seen, double-digit increases in valuations year in, year out. So what you do, if you own a large property, you hire a consulting company. They, then help you protest and get those valuations down. And there's several methodologies they use, but most recently in the recent past, kind of in Texas, there's a statute, equal and uniform. So if you value my neighbor's property that is of similar like kind to my property at a lower value than mine, that's unfair. So we can, file a lawsuit and protest and settle our value closer to what the neighboring property has. So it's a year in, year out grind that sometimes takes, up to 2 years to settle. So, it's been a perpetual problem and real impactful financing, I'm sure, as you can attest to, Paul, the last few years in general, where these counties have been still playing catch up on values. And real time, we're seeing rents go down and occupancies go down and other operating expenses go up. So your NOI is declining, but they're still increasing the taxes on you. And then you pay these taxes, and then you have to wait, sometimes 24 months, 12 to 24 months to get a refund on, we're just now settling some 2023 cases. And here we are in April of 2025. So, and I still have multiple 2023 tax protests, in process. So it's just a perpetual grind, to say the least, Paul.
It's tough out there, but what I like about Ryan, Ryan, like you, have lots and lots of units, and seeing the problem out there, Ryan was convinced that he could solve it. He could solve the situation and be kind of a fly in the ointment, so to speak, to try to help folks that own multifamily properties, own real estate, own commercial real estate, to try to win those battles with the county assessor's office. And so Ryan, tell us a little bit about what you're doing now and talk a little bit about what you and Clayton have gotten into.
Yeah, absolutely. I love this segue that we've gone on here. But no, like you guys are just mentioned, I mean, property taxes in Texas are absolutely insane. The great thing about living here is, we don't pay capital gains tax and we don't pay income tax, but the state's got to get their money somewhere. And, the fact that taxes get reassessed every year and there's no caps, it's been incredibly frustrating for all of us multifamily operators. And, Clayton was our consultant for the last 7 years and known really well. And, I just knew that this environment that we're in was so frustrating that, there was an opportunity to have a company that just focused on Texas multifamily property tax consulting. And Clayton, in his expertise and his acumen, would be the perfect person to partner with. So Clayton, why don't you introduce yourself and kind of give your background and talk about.
Hello, my name's Clayton Sievers, partnered with Ryan on Valorum Tax Advisors. I'll give you a background on kind of how I started. I also graduated from Texas Tech with a prestigious economics degree and had to figure out what I was going to do with that. I somehow stumbled upon the county central appraisal districts. I always had an interest in real estate and figured that this would be a good segue into the multifamily world. So I started my career, thankfully, with a guy named Lonnie Henry, who actually worked at Tarrant County Appraisal District, actually became the deputy chief down in Travis Appraisal District, and he got me an opportunity to work at Dallas Central Appraisal District back in 2015. And my goal was to learn as much as I can and then trying to find some other outlet through multifamily. But I don't think anyone's ever said this before, but I fell in love with it. I fell in love with the negotiation. I fell in love with the people in the industry. And so that is what I've been doing for the past 10 years. Obviously, I don't work at Dallas Central Appraisal District anymore. I was there as a senior appraiser until 2017, then transitioned to over what they call the dark side, which is representing the taxpayers. And so I've been doing that since 2017 for the past 7 years. And then Ryan and I recently started Valorum Tax Advisors. And part of the reason we started Valorum was there was a big industry shift where local specialized firms were being acquired by nationwide firms. And that's really kind of been going on for the past little over 5 years. And it's really opened up a demand for localized special consulting because in the United States, Texas has one of the largest property taxes. And for multifamily owners, it is typically the largest line item. And it can be also the most volatile line item that they have. So we've created Valorum to specialize exclusively on Texas multifamily and really built our team around it. All of our team is ex-appraisal district professionals. So we have a deep knowledge with the property tax system. Plus, between Ryan and I's expertise in multifamily, Valorum was born.
That's great. As I look at Clayton and think about what Ryan and Clayton do together, I see them as Vikings with these big horns coming out of their head with their charging big mallet. And
Yes.
They're charging the castle. The castle is the county, and they're coming at the castle with all the knowledge and all the people to try to get your property taxes cost lower. And people don't realize, again, how large these property taxes can be. And that's what I was joking around with Becker about. They pick you up in a freaking limousine with chilled champagne in the back, and they don't. But they have no problems charge you millions of dollars. So give people who are not from Texas or are thinking about investing in Texas what property taxes are. When we talk about a millage rate or a multiple, in California, we have Proposition 13, it's like 1.25% on the valuation when it was originally bought. How, again, Clayton, for the back of the napkin, give people an idea of how much property taxes are?
So if you look at a percentage of just a potential rent collected, it's usually around 15 to 25% of the total income collected from a rent perspective. So it's significant. In DFW, Dallas, and Tarrant, over the past 5 years, it's been an average increase of 12% for the past every year. And last year in 2024, it dipped slightly to around a 9 to 11% increase. So even though we had a massive shift in the market, the appraisal district, the valuations haven't shifted as much to reflect that. And part of it is that the appraisal district, since the assessment date is January 1st of each year, they're always looking at 1 year behind in their data. So what we're feeling right now is not exactly what these assessments are reflecting. They're reflecting past data. And then on top of that, in most counties, I would say like North Texas, they've historically been behind trying to chase the market. The market has increased significantly since 2020. And since there's obviously great remedies in the tax code to help prevent these increases through equal and uniform and appeals and filing lawsuits through the district court, it's slowed those increases down to not match the exact market. So as we're feeling the market suffering and we're losing value, the districts still believe that they have room to try to catch up to that market because they're supposed to be 100% of true value as of January 1st. And what really motivates them is that the Texas Comptroller will do a ratio study on them every other year. And they're grading them how close they are to true market. And if they're outside of 5% of true market, then they could potentially lose state funding. And so that is what motivates and drives them. And so for this next year, some of this, Paul was saying that by the time this gets released, it might be a week or two, so values might already be out. But as of now, it's been most of the smaller counties. Harris has been out, Travis has been out, and a lot of it's kind of mixed results. There's some counties that have increases. I've seen a lot of properties be decreased, but then you'll be surprised and all of a sudden you see a pretty substantial increase, especially in Travis County, right, Becker?
Yeah, that's right. Yeah. I was just complaining before we started recording how at 3, 1 went down and 2 went up, and all the rents are lower than they were a year ago. Just nuts.
That's going to be very difficult for them to justify that, especially since Austin has had some of the largest decreases in valuations across America. And there's tons of data to prove that. So I'm not sure what their stances are. Travis is one of the more aggressive counties. They're one of the few counties that actually file suit against the owner if they didn't like the ARV value. And most of the time, if you're filing suit on grounds of equal and uniform, they will countersue you on the grounds of market. And so if you do happen to end up in trial, you'll have to present both cases. And so they've really set the stage for what Paul was saying, bring your axes, bring your Viking helmet. I mean, that's kind of the environment down there, unfortunately. And they had a monumental case go through the Supreme Court last year, Texas Disposal, where they sued the property owner for getting a low valuation through ARV, and that made it all the way up to the Supreme Court. And the Supreme Court made some really shocking decisions where they're allowing market to be introduced into an equal and uniform appeal, which historically has not been the case. It's always been equal and uniform reigns supreme. Market value is a completely separate issue, but here recently they've introduced that as a variable in the equal and uniform argument. So the landscape's changing a little bit. The good thing is as we have made these settlements, it hasn't really been that much of an issue. But if they're serving discovery, because of that recent ruling, you're having to give up any type of market data. However, giving up market data right now in this environment is probably good, right? Equal and uniform is probably not the right route to take anymore. It's really proving true market value is what's going to help. I think that's not going to be as big of an issue as we think.
So you mentioned something, Clayton, that just kind of stuck out to me, that 2024 is up about 10% from 23 values, right?
Yep.
And that's probably, is that based off the ARB certified roll, not because it seems like I'm still fighting 23 level and 24. So that should kind of come down over
it will definitely come down. Yeah, it will definitely come down. So yeah, that was based off that data was pulled in November of 2024 because I want to have a snapshot of what that data was right after ARB. So the personalities between Dallas and Tarrant are pretty drastic. in Tarrant County, in my opinion, I think Tarrant County has the best equal and uniform approach when it comes to litigation. They're very open to receiving your argument, and I think they do it the most in the fairest way. And so we're seeing litigation in Tarrant really coming back down to last year for most of the properties. So after the dust has settled, it's probably an overall increase of 5% at most, because they're truly matching the decline in the market. And so, but with Dallas is a little bit longer play. Their settlements take much longer to resolve. A lot of the courts, the district judges are fighting it back against that, not allowing any continuances, trying to speed that process up. And so right now, coming out of ARB in 24 was about a 9% increase, which might come down to 6 to 7% increase overall.
It's funny because like internally we talk, and like, you know, our asset manager kind of runs point on protests every year. It's like, you know, the mantra for me is like 23 is peak tax year.
Yep.
And 24, we got to be lower than 23. And if I got to fight it for 2 years, we fight it for 2 years, well, unless there's an exceptional case. And so I think we're just, you know, in this for another year on 2024 at least. And we're just going to, you know,
Without
we
a
paid
doubt.
in, and then they got an interest-free loan at the county for, you know, 18 months of my money before I get a refund or something like that. And it seems like we're starting to get some of the 23 success, because, you know, 23 is probably your peak tax year, because that's like captured the 2022 kind of operating statement essentially, and 23 captures, you know, and 24 captures 23 and so forth and so on. And then so it kind of seems like to me that 23 should be the peak if you really fight it, and then 24 should be lower, and 25 should be lower than that, and then we'll see about 26, because you're just, you know, that lag. You know, and it just seems like it's just been so brutal trying to fight through them. But we're starting to see like capitulation, like Bexar County. I always thought of Bexar County, which is San Antonio, to be the most aggressive county appraisal district, like in the entire state, or at least of the bigger ones. And it seems like we've gotten a few wins down there, and they're capitulating in real time. And you know, it seems like Travis is just smoking crack with what they've come out with, and this is no way. So I'm assuming, you know, they're just going to get bogged down and just, you know, being paralyzed with everyone suing them, because there's just no way. So I don't know. Any thoughts around that?
Yeah, you're right. There's a division from the southern counties to the North Texas counties. Your perspective of Bexar County being the most aggressive is accurate. That same personality is adopted by Travis and in Houston. They all kind of have that aggressiveness. And because they've been so aggressive, they've been closer to market. So since they've been closer to market, they're going to react to the market more fluidly. So as values do come down, their value should come down as well. And they should reflect that. Bexar, Travis, and Harris County all saw overall reductions last year from 23 to 24. And that's after AR. That's starting at ARB certified roll. So after litigation, that's going to come down even more. In Bexar County, it was an average decrease of about 2%. Travis, it was 3% reduction. And then Harris County was an average of 4% last year. And as I'm looking through, most properties filed lawsuits, which is good to see. I mean, you have to continue and push. As much as the district is pushing and increasing values, owners should be doing the same. And it's just it's better for the community, because everything reacts off of equal and uniform. DFW is a little bit different, since they're just further behind on true market. It might not reflect those changes. And so there still could be some increases, maybe 0 to 5% increases for 2025 once the dust is settled, but the dust has to settle, because I do believe the values that we're going to see coming out are going to shock everybody. I'm thinking it's going to still be preliminary values at a double-digit increase over the ARB values.
The ball's on them. Paul, anything as it relates to lending and anything that maybe Clayton can help with on the lending front, that maybe borrowers can ask consultants for studies or anything like that?
No, I mean, the biggest thing is what you're hearing right now in this type of a discussion is that Michael has seen this have a financial impact by property taxes that continue to rise, and if left unabated, they'll rise every year, and that it's out of control. I mean, it is truly this large line item that keeps growing every year. And some people don't hire consultants And I think that's not bright. That's not right. And so you have to have a tool in the toolbox, and Clayton and his team are the one that they're the tool to help you. So I'm going to call Clayton a tool these days. Don't take it the wrong way, Clayton.
I love that's a great compliment.
A very positive way.
Yeah.
But we certainly want to have people understand is that, they can probably do it themselves, but you will not have the success that Clayton and his long team and knowledge have, where all the rules are in this business to try to save you money, and go with somebody that's been there, done that thousands of times to kind of help you save your pennies and dollars and property tax line items.
I was just going to say, Paul, one of the things that we've always done trying to acquire apartments over the years is, working with a consultant like Valorum Tax Advisors to properly estimate what your taxes are going to be in your underwriting. Year 1, year 2, year 3, have an understanding of realistically where those taxes can be. And so you're not surprised when you do have this increase. And every county is very different, as Clayton has, kind of articulated, and that working with us to get one of our Valorum reports on a deal that you're looking to buy can really be beneficial to other multifamily operators.
I agree. So let's let the tool tell us the best way of getting a hold of Clayton and his team.
The best way is to email Ryan and I. It's Clayton at valorumtx.com. And then Ryan's is Ryan at valorumtx.com. We really could just do it with just a property address, but obviously the more data, the better it's going to be. So if we can get a trailing 12 rent roll, guided price, and then where you believe you're going to end up at the deal, that is pretty much all we need, unless there's some more narrative to the story about its distress, the bank, the lender selling the loan, something like that. Obviously helps to make sure that we can articulate that to the district, because every time I look at those, I look at it as how would I appeal this and how would I present this data during an ARB appeal. So the more data I have, an understanding of the condition of the sale, the better and more accurate it can be.
Yeah, and if you're an operator and you just got your the values just came out, give us a call. Let us help you fight the good fight.
With our Viking hats on.
That's right. Put your Viking hats on.
Yeah.
Michael, any final words before we say it?
Oh, yes. As you mentioned, it's a pretty big line item. I've never heard anyone express it like Clayton just did, which is shocking to think it's like between 15 to 20% of your revenue line goes to taxes. I haven't thought about it that way. And that's, staggering. And the balls on these guys increase 10% in Dallas County, if that's what comes out, it's just absolutely appalling and shocking to me. And I keep having this mantra that we're fighting to the death. Like I'm the last guy that's going to settle, and I'm the last guy. So let's just push, and we're gonna just push. And I think that's being a good fiduciary to everybody. And I think that that's also probably just kind of as a greater encouragement to everyone out there that owns apartments, that your taxes, if you have done right that are shown on your historical financial statements, are inflated. They're overstated by, a percentage, and that when you go get that big tax refund, it's like you're 18, 24 months in arrears on what you actually paid and what you reflect in your financial statements. And if you go get a big 10, 15, 20% decrease, and it's, 15 to 20% of your revenue, it's a pretty material, savings. So I think a lot of the financial statements you're seeing are temporarily overstating what the actual tax number is going to be upon settlement, 18 months forward. So just kind of thinking that the rearview mirror is probably not as bad as we think it is, just with that one large line item about to be adjusted if protested successfully. So I think that's hopefully a little bit of encouragement, and trying to, if you have to give narratives to investors or to your various lenders, that's certainly something that we bring up when we're having conversations like, hey, we paid $1 million, but we expected to get down to $850,000 and get a $150,000 refund, and in 6 months from now, or whatever the the narrative is. So that's just something that's kind of been on top of my mind related to property taxes recently as we're going through having conversations with various people, Paul.
Yeah. I was just going to say, Michael, the thing that you just said that I loved is being a good fiduciary. This is part of it. So, fighting your taxes, using the appropriate consultant, hopefully us, is definitely, shameless plug. It is part of being a good operator and taking care of your investors and doing what's right for the property, especially with the environment that we're in right now and rising operating expenses and a rocky capital markets. So it's we need, as owners, we need to be using all the tools, to go back to that phrase with Clayton, that we can to keep NOI as high as possible.
That sounds great. Okay, Ryan, thank you very much, Mr. Multifamily here in the Dallas-Fort Worth area. Ryan Heddleston, thank you. The Viking himself, Clayton Sievers, thanks for spending some time with us. Michael Becker, always a pleasure. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.